Welcome to the Broken Pie Chart Podcast, episode 369. I'm your host, Eric Moore. With me once again is Mike Snyder and Shane Skinner. Okay, we are now 6.77% off the all-time high, and maybe later we can talk, play the guessing game. Do we get to 10%, or is this the bottom, or is 10% not the bottom? We'll see. I want to start off, though, just a couple things. One is this continues to be a multiple contraction. So I pulled up today and I looked at the S&P 500 index. And according to Bloomberg, the forward 12-month estimate, and I think they have 16% growth forecasted in earnings. In the end, it always comes back to earnings, but about $332 and change a share. And that's probably about the highest ever a forward 12-month estimate has been. It's what the analysts are saying earnings are going to be over the next 12 months. But you look and you say, well, we're off the all-time highs. We were a forward PE back in, in October, which we'll get to when the NASDAQ crested and kind of had its all-time high. I'm showing on Bloomberg 19.73 is the forward PE. So earnings estimates have been going up. The market's coming down. Like, this is a multiple contraction. And the reason why I bring this up is, and you go back in history, sometimes the market is right. Sometimes the analysts are right. So far, the analysts have not wavered or not reduced their estimates. You go back to, 2021 into 2022. Of course, 2022 starts the bear market. And then we saw the same thing. We saw forward PE ratios coming down. Earnings were still going up. But the market, did it anticipate it? It started to come down sooner than analysts adjusted their expectations. So that was a multiple contraction. Interestingly enough, the market's bottom basically around September, October-ish of 22. But earnings didn't bottom until really March of 23. So the market anticipated earnings are coming down. The market anticipated that earnings were recovering. And that's not unlike markets. Typically, they certainly lead the economy. So I guess, do we think, Mike, I'll start with you. And I feel like we talked about this last week. Like 6.7%, is that, it's not crazy. I mean, do we go to 10% down first? Do we firm? And I mean, do you think the analysts are going to be lowering estimates?
Yeah, I mean, 6.7% really isn't a big number. I could see more downside here. 10% pullbacks happen, 20% pullbacks happen. They're part of the market. Usually they're for different reasons, but part of being invested in equities is, the long-term growth in exchange for that sometimes short-term volatility. So I wouldn't be surprised if we continue to sell off from here. And yeah, I mean, that's the question is, are the analysts at some point going to come in and start lowering their estimates, and the market's, giving us a signal here that earnings aren't going to be as strong? Or is this sort of a blip on the radar and these estimates hold? Companies continue to report solid earnings in spite of potentially lower profit margins due to higher input costs, and the market has a quick recovery from here.
I mean, Shane, we've talked a little bit about too the idea that yes, the market all-time high was, you just told me this? It was January 28th, 27th in the S&P. But the all-time high in the NASDAQ 100, which is where syncs up with kind of the Mag 7, if you just isolated those companies, their all-time high was in October. So I don't know, can we read anything into that? Are those kind of getting cheap enough that people start to get interested?
Yeah, I think that's sort of the big question, right? We're below the 200-day on the indexes, and the saying is nothing good happens below the 200-day. So I'm with Mike. I think we could continue to see more sliding, but realistically, markets, where are we relative to we closed today? Last time we closed around this level was September of last year, mid-September.
So we're seeing levels in the market we haven't seen all the way back to September. It's not like 2011 where we're like, we haven't even crested the highs from, well, I remember like the NASDAQ in 2000. I think it took 13, 15 years to regain the 2000 high.
Oh yeah, it took quite a while. Buddy and I were actually looking at that last night, just looking back at that whole run, and eventually, this is why it goes back to, you buy and you hedge, right? Because you just don't know, and you would like to, if the sell off continues, if things get worse for some reason, and good luck predicting what it's going to be that causes it, right? The black swan is something you can't really predict. And that's, again, why you sort of have to acknowledge that you can't predict it, and you bite the bullet and you hedge when nobody else wants to. And that's, it allows you, if this continues to slide, to be able to cost average down, buy more stock, or just simply
or do nothing, because if you're a long-term investor, like this shouldn't worry a long-term investor. Like if someone's goals have changed, that's a different story. But if someone is a long-term investor in these markets and they've got a portfolio that's set up based upon what they're trying to do, right? The whole caveat. Like this is normal. This is normal stuff.
Oh yeah. Yeah, absolutely. I mean, look what happened through 2022. 2022 felt brutal, and yet within a year or two later, we had made it back. Not saying, that's a guarantee if we were to slide more, but market's resilient. There's a lot of ways this could go from here. And I think people, aren't you seeing on the technical level across a couple of different technicals, it looks fairly oversold. Again, sometimes that doesn't mean it won't continue to go lower, but you seem to have a lot of things pointing towards be a potential bounce here. We'll see.
Well, there's a couple things, and here's what I think people should be thinking about. Number one is on a technical basis. Today at one point we got down in the S&P, we were sold off over 2%. I think we closed down 1.5 today. So, when we look at that, I would say it's been a rather pedestrian march lower from the all-time high. We really haven't had one of these crazy days where there's a washout. Yeah, the VIX was up over 30. The VVIX up over 130. Those are interesting levels. But fundamentally, and fundamentals sometimes take a little bit of time to update. But just to give you an idea, we were talking about the S&P before. The NASDAQ 100, the analysts are forecasting 30% earnings growth over the next forward 12 months. The NASDAQ 100 at one point had a forward PE on 1029, which I think, we almost got up there again and on 128, but I think 1029 was the all-time high, for a closing high anyway for the NASDAQ. Just under 28 times forward PE. At that time, the forward 12-month analyst estimates per share were about $931, $932. Today, those forward estimates over the next 12 months are $1,109. But today, the forward PE is only 21.75. So analysts have not adjusted yet. And I think that's really, if you're asking me what people should be thinking about, is when do analysts start to make some assumptions based upon the environment, whether it's the conflict, the war, whatever people officially are calling it, whether we're talking about inflation, all these types of things. But I would just tell you, if you take away the news and the reasons and everything else that you're seeing, and you just look at a chart, you would say, well, we kept going up, we crested, and now we're going down. Like, we haven't really seen, Mike, this just blowout. And when I think of the blowouts, I mean, Liberation Day, the tariff day, like those were blowouts. Those were like real surges in volatility. Like this has been a downtrend.
Yeah, it's been a pretty orderly downtrend. I mean, the VIX closed lower today than it did at the end of last week, which just I think goes to the point that there's still investors out there that are looking for opportunities to buy and are buying on every dip. And I don't see the fear yet in this sell-off that we've seen in some previous sell-offs.
One of the things, Shane, you had sent over, and I'll just kind of explain what break-even rates are for the audience, since it may not be something everyone's familiar with. You had sent over a chart somebody had posted on Twitter of the 1 year forward break-even rate. And basically a break-even rate is looking at a 1 year, in this case, a 1 year treasury and a 1 year TIPS bond, treasury inflation protected security. And you're looking at the spread between them. And I think when I pulled it up on Bloomberg, it was 5.36% is the 1 year forward break-even rate. When people look at that, they read in that people are expecting 5.3% CPI inflation in 1 year. And that may be what they expect. But just to explain what this is, if your break-even rate is 5.36% and you buy a 1 year TIPS bond versus a 1 year treasury, regular treasury, you are indifferent to owning either asset if inflation, in fact, is 5.36%. If you think inflation is going to be less than 5.36%, you'd rather own the treasury. If you think it's going to be more, you'd rather own the TIPS bond. That's kind of what that's looking at. Shane, you remarked, actually, you didn't even say anything. You just sent over the chart, which I think is interesting. And my first remark was, and I'll explain why, the break-even rates aren't a great predictor of future inflation. Exhibit number 1. In March of 2021, the forward, let me see here. The forward 1 year break-even rate was about 2.8%. You fast forward 1 year, what did CPI wind up being? 8.5. So March of 21 to March of 2022. Okay, well, it certainly underpriced that. And then you say, okay, well, 1 year from there, we say, what was the break-even rate in March of 2022? And it was, in fact, higher than it is today. I'm going to hazard a guess to say it was close to 6%. Let's go to March of 2023. March of 2023, let's see, about 5%. So close, but overestimated. But the expectations are coming in. And I think, Shane, that was your point. Like, people now are starting to think, although the analysts haven't changed, they're thinking higher inflation, stronger dollar, high oil, all that is bad for markets. All that could cause a recession. All that could cause corporate profits to narrow. And analyst expectations are saying 14.8% is the forward 12-month estimated net profit margin. Sales, by the way, are predicted to increase 8% over the next 12 months. So, Shane, sorry, I kind of poo-pooed on your break-even chart, but I know that you just sent it to show like this is sort of the expectations that are being built in, right?
Absolutely, and I always send anything that looks remotely bad, and I look for you to. You
are a perma bear.
Tear it apart, right? I need you to do that for me. I need someone to explain to me the other side. So I appreciate that, but yeah, this has to be coming from the rise in energy prices, right? Gas, the oil shock. I think that's what you said, like expectations of rising inflation are starting to come out from, the people surveyed that this is made up of, or however this is, calculated. And Fed Chair Powell spoke this week. There was the FOMC meeting. We didn't change rates, and a ton of questions obviously got brought up around like the impacts of what's going on with oil, having on the economy potentially. And I think the overall gist, because, producer inflation came in a little hot again, I think. And so I think people are getting a little spooked, and it might be a little too early, right? There are numerous times, as we've looked through charts, right, that we've seen, blips or spikes or little rises and then coming back down in PPI or CPI. It's just how it goes. But, I think this all, and not to sound like a broken record, and it's going to continue to revolve around energy prices. And just because, like you've said, oil's embedded in everything.
All right. You mentioned the Fed. Mike, you and I were talking yesterday. Maybe I wasn't talking to you, but I'll go with it anyway. Actually, this was a conversation with somebody else, but I'll ask you now. This talk about Powell. So Powell doesn't have to leave the Fed because his Fed term goes further than his term as chair. So there's a scenario where he could stay on as just a member of the Fed, but he wouldn't be the chair. And somebody, I think, picked up on this and said, well, how is Trump going to get Kevin Warsh onto the Fed? But I believe that Mirren, his seat is, I think it's up, but he's serving on like a temporary basis. He's extended the term until they confirm somebody. So can't they just confirm Warsh and Mirren can step down? He can slide into that, and then they just make him the chair?
I would think so. And Powell did say he was undecided on, his future, and that he may potentially stay on. Who knows if he's already made a decision or not, but that's what he said. And he also said if Warsh was not confirmed in time, that he would temporarily remain as the Fed chair until someone was put in place.
So here's how this conversation goes, Mike. It's, hi, this is Jerome Powell, speaking metaphorically to anybody. How about you guys drop all the inquiries and what did they refer? He didn't get, they didn't okay a subpoena in front of the grand jury. I forget what it was, but they're looking into overspending by the Fed. So the conversation went, hey, if you guys drop this, I'll resign my position. You can fill my position. But if you don't drop it, I'm going to stay on and just make it harder for you to get somebody else on. Like, Mike, don't you think that's the conversation right now? Like, he's not staying. He wants to go write books, get paid $500,000 to go speak in front of Goldman Sachs at a lunch meeting.
Yeah, I can't see him staying. I mean, has that happened in the past, Has a Fed chair stayed on?
Not that I can remember. I think Yellen stepped down. She could have stayed. No, they don't stay. Why would they? They want to go on the speaking circuit and make millions of dollars.
Yeah, I can't see him wanting to stay. I think he's leaving himself multiple outs in case he needs them. And probably using it as leverage, like you said.
I think he loves the job and wants to stay as long as he possibly can.
He'll have no power.
He won't. No. And he doesn't want to stay. He doesn't.
Somebody brought up that, so Bostic, and he was a voting member last year. I don't know if he's a voting member this year. Somebody mentioned that he's stepping down and retiring, but I pointed out it is the Atlanta Fed who would nominate his replacement. So there are kind of permanent members of the Fed, and then there are the regional banks which nominate their own person. And there are times when they're voting and times when they're not voting. So that wouldn't help Warsh get. That's not a seat that's open, if that makes sense. I don't know. Probably going too far into the weeds on the Fed, but yeah, like Mike, this is all just posturing from Powell, and I think as soon as Warsh comes in, they're lowering rates.
I agree with you. I think they could have multiple reasons why to do it, or it's just their directive and they're going to lower rates. I think at least once. I think you said maybe previously you're leaning towards 2 this year.
At least 2.
Yeah.
At least 2. Like if you think about, Warsh obviously had conversations with Trump, and probably Warsh is going to lower rates. And now they have the backdrop to do it. They could say, well, the economy is a little bit shaky. And I always caution people, be careful what you wish for. Like if they are lowering rates because the economy is doing bad or the markets are doing bad, they're doing some kind of an emergency cut. That's not good. Like you'd almost rather high rates, thinking about lowering, but no problems that they need to address. And I will tell you, Shane, and I've said this before to you on the podcast, them raising or lowering rates right now would mean nothing to prices. It is a supply chain issue right now, pure and simple. That's all it is.
Yeah, and energy mainly. I think like your 2 biggest sources of inflation are going to be due to exactly what you just said, supply chain issues, and then I think you throw in energy in there. And I'm going to make an argument here. You guys might buy this, you might not. Most people think that, okay, let's say energy becomes more of an issue than what it is now. More scarce, higher in price for much longer. If for some reason we need to ramp up production and processing, specifically down in Venezuela, if something ends up coming from that, right? You need to lower rates for the CapEx and for all of that going on. Like lower rates allows us to better deploy capital, right, into those things that then allow us to allocate the resources to bring the inflation down in those areas. Like if gas prices are up, it's not because you're seeing inflation in, household good supplies, right? If gas is up, it's because it's oil. Household food supplies could have, it could be wheat, it could be corn, it could be something to do with weather, it could be something completely different. But like where I'm getting at is that if we're in a situation where we need to ramp up investment into manufacturing or energy, or even AI, we need lower rates.
The counterpoint to that is, for an oil company to seriously put CapEx, it's how long does the CapEx, what's the lead time on spending money to ramp up? And you also have to believe that this move in prices is more permanent. So if you think that this isn't permanent, like you're not going to activate a bunch of wells. You're not going to all of a sudden spend a bunch of money on new drilling or new exploration. Like those are long-term projects. I still think, I'm old enough to remember the 70s and waiting in lines. So, odd plates used to go on a Tuesday. Even number plates would go on a Wednesday for gas. And people used to wait in line for gas. And you had the spike. I mean, the difference now is that we have so much more production. We're a net exporter of oil. So I don't think it's an issue with the US. I don't think it's an issue with Canada, like North America. It's obviously an issue where you can't get the Strait of Hormuz, if that continues to be shut down and you can't get oil to China or can't get it other places, like that's an issue. And here's the thing, Mike, I mean, it is a midterm year. So, and I said this before, I'll say it again. Like if you want to have discussions on wars or politics or anything, that's not our beat. Like we're strictly looking at this through market lenses. Mike, if I'm this administration and I have the midterms, they got to hopefully wrap this up sooner than later, because you don't want this going on into the midterms. It's not going to be good for them.
Yeah, absolutely. They want to wrap this up sooner than later. I mean, the president does not like seeing the market down in general. And so, that's the thing. This could be, it's not only is oil going to keep going up, I think the bigger question is how long does it stay at these levels? And so, if this war is ended quickly, you could see this reverse quickly. If this thing drags out, I would expect it to continue to trade around here. I think the market thinks it's an issue in terms of interest rates. Wouldn't you agree? Like the amount of cuts that the market has been pricing in has been going down.
But don't you think, Mike, like people are talking out of both sides of their mouth here because they're saying this is going to hurt the economy. And if the economy's hurt, don't you need interest rate cuts? Like that's the playbook of the Fed. So
right.
You're telling me like, oh yeah, oil's going to be at $200 a barrel and the economy's going to be too hot to lower rates. Like that's not happening.
Right. I think we have been so focused on the inflation number in order for rates to be cut that it seems like the market has forgotten that rates can go down when inflation is up if it's needed to help the economy, which I think would be a potential reason to do this. If the economy, I think right now, if the economy stays on the same track it's on, we have higher inflation, then I think it could be sort of a rallying point for members of the Fed who don't want to lower rates to just point out inflation and simply say it's too high and that the economy is still strong.
Yeah, I'll have to look at the voting members. Miran, I think at the last meeting, he wanted 3/4 of a point cuts. So he's, the outlier there. Warsh, I think, is going to lower rates. But historically, the chair gets what he or she wants. And so that's why I think they're going to lower rates. But yeah, look, if I'm the administration, I'm trying to wrap this up. The problem is it takes two to tango. And whether or not the other party in this, Iran, is going to acquiesce to some agreement, or whether they're just saying, they're playing with it's sunk cost at this point, where it's a sunk cost fallacy. They're like, no, we're going to keep going. We think we can hurt the economy and put pressure. It's their play right now to hurt the energy infrastructure, to cause pain that will cause the other side to capitulate. Like that's pretty clear what they're doing. But there's no indication that they're just going to acquiesce. Like Venezuela, we went in, did whatever we did there, and that's done. We've done other stuff, and then that's done. So market doesn't like uncertainty, Shane. That's the other thing. And right. Market thinks, I always say this, the market thinks it knows what's going to happen, but it doesn't. But I don't think the market knows what's going to happen. And it, as I just said, it doesn't. Like we're in that phase right now.
Right. Right. And you have, if you want to go off, I believe, would you describe a bear market as the stock trading below the 50 and the 200-day moving average? Would you say that's like a bearish trend?
I wouldn't call it a bear market. I think this is just a normal take away the news, cover up the headlines. It's just, this is normal. This stuff happens.
Yeah, the profit taking. And we're sitting at a pretty key level over the past 6 months, like we said earlier in the podcast. And again, I think we even mentioned it prior. Like, what if we tested the high from, like February of last year before the tariff tantrum, right? You were on the S&P 500, you were at 6151. So that's 850 off 7,000. So you're just over 10%, probably closer to 12, right? 12% off the high would put you at the high before the tariff tantrum sell-off in 2025. Mm-hmm. That's really not that far. That wouldn't be that crazy of a move, right? Like you said, take away the headlines. Headlines are not. That kind of a pullback after the run we've had over the past couple of years isn't unhealthy.
Yeah, that's worth talking about too. So, people forget we did have a bear market in 2022. I don't know why. Like we've had these V recoveries, Liberation Day. We've had, the tariff tantrum. We had the nonsense with the yen carry trade. We had all this other stuff. But we had a legit bear market. So let me just read off some of the S&P numbers. If we kind of take a look at, how do we want to do this? Yeah, let me look at this. Give me 1 second. So last couple of years, full year 2025, total return plus 17.89%, plus 25.05 in 24, plus 26.27 in 23, minus 18.10 in 22. When that was a bear market, we were down over 20% for the a structural bear market. But then the 3 years prior, up 28.72, up 18.40, up 31.5. Okay, down 4.38, up 21.84, and then up 7.83, going all the way back to, oh no, that's not a full year. It's up 21.84, going back to 2017. I just have this data in front of me. Like
that negative number is not COVID year either, 2020, is it?
No, 2020 is plus 18.40.
Right. So it's just, we V-shaped in 2020.
But look at those years. Like if we have a minus 10% year or minus 15% year, in the grand scheme of things, long-term investors, like look at the run the S&P's been on.
Right.
This is really, it's been a really good run.
And if you're my age, someone who's, got a long...
You shouldn't be checking if a normal person, you're a trader, but normal person should just be plowing money into the market every paycheck and just calling it good.
Exactly.
And stop trading crypto and prediction markets and all that. All right. So, Mike, any closing thoughts on this? I want to go to, I actually want to talk about the prediction markets a little bit, but anything else on this?
I was just going to mention, like, I think the market needs the Mag 7 for the recovery to happen. Okay. That was all I was going to mention. I think that, energy stocks have continued to do well. It's not enough to hold up this market. I think for the market to really recover, you're going to need to see some outperformance again from the big names.
What is the Max 7 down from the all-time high? Do you guys know that? If not, I can just do it real quick.
I don't know.
Yep. Give me 2 seconds and I'll do it. So their all-time high was in October of 25. Yeah, so they're off 15.5% off the all-time high. So
I wonder what the NASDAQ is. I bet it's roughly the same. NASDAQ 100.
Yeah, let me look. Or I can look at the Qs. I can look at those too.
Yeah.
So if I look at the Qs, yeah, because I think we already said their all-time high was end of October. Which isn't surprising. So yeah. So what did I say? 15.5 for the Mag 7?
Yeah.
8.5 for the NASDAQ. So no, it's not down as much because you have more diversification there. So, which tells me also that the other stocks, the 493 in the S&P's case, or the other 93 in the NASDAQ 100's case, have been doing better. But Mike, to your point, yeah, these bigger stocks, and there could be other stocks that come in, I don't disagree. Somebody has to get interested in them. Like, okay, at what point does someone come in and step in on Tesla and Microsoft and some of these like Mike? What is Microsoft down? Microsoft's off what? They're in a bear market.
Yeah. I think this just proved Mike's point entirely. Like that difference between the Qs down versus the mags.
Yeah, we saw the market broaden out, right? We had a lot of stocks performing well, outperforming the Mag 7, but the market really was just sideways for a while. And then as soon as there was some bad news, and that was just, Iran and oil going up, it wasn't enough to hold up the market. So I think that's just how I'm looking at this. I think the Mag 7 needs to lead this recovery.
Do you think, Mike, like, because it was almost like value, like the stuff that wasn't growing nearly as much, obviously, as like tech and the mag names, was sort of carrying the load the past couple months, right? As the index sort of moved sideways and those bigger mag names in tech sort of slid lower a little bit. Do you think it's because the growth potential in the names that the tech sort of passes the baton to is just so much more limited than the growth potential of tech itself? And so, like, you're only going to get so much growth in Procter and Gamble, right? Before it's going to sort of go, okay, well, how much more can margins get better, right? Or what more can they do other than what they normally do?
Yeah, I was going to use that same stock as an example. Like what's the real upside potential in terms of a return for a stock like Procter and Gamble versus a stock like Nvidia or Google? That's at the front edge of AI and technology.
Nvidia's gone sideways too for a long time. I know it's probably down a little bit, but if you look at a chart of that, it's been really sideways. Like, it's been getting cheaper. Forward estimates, same thing we were talking about with the markets. Forward 12-month earnings estimates, all-time high for Nvidia. Forward PE has come down, but the stock's been kind of flat. It's almost like crouching down, waiting to see what direction. And it could break down or it could break up. I'll let you know when I know. But Microsoft, by the way, is down 29.5% from its all-time high. So if you like Microsoft, it's cheaper. I think Tesla is the other one that's kind of off by a lot. I don't think it's off by that much, though. Let me just look at Tesla.
Meta sort of beat up Amazon, sort of. It's so odd to see the market has held up while these names have been down 10, 15, 20%.
No, it's been the other things. I mean, we run a strategy that incorporates the top 10 or the top 8 stocks X Berkshire, and then Google's listed twice, so you lop off one of those. And we were kind of remarking, like, at what point do some of these stocks fall enough that Exxon was nowhere near the top 10. What do we say? It was like 13 maybe?
Yeah.
Now, yeah, I mean, Exxon is now after the run. So that will be interesting. But those stocks were so much bigger than everybody else. Even after them retracing, it's not enough to kick them out of the top 10. So, all right. Let me move to, you know what, Shane, let's talk about this. So Shane, you had sent over something from Twitter, and this is from Sherwood. And this is hyperscalers' estimated free cash flow for current and following calendar years. So this lists Meta, Amazon, Google, Microsoft, and Oracle. Oracle doesn't really surprise me because I think they're taking on a lot of debt. So their debt service may be, and they're spending a lot. So basically what this tells me, Shane, is that these companies, they're using their free cash flow, and instead of paying it out as a dividend or reinvesting it, instead of buying back shares, they're spending it on CapEx or debt service, or, I haven't broken this down. But I mean, that's basically what it's saying, Shane.
Right. I mean, they're spending cash, and whether or not that cash is going to come back to them in the form of revenue, like if this is heavy investments in equipment, chips, data center stuff, right? Like, if it's long-term investment, then yeah, of course, you're going to see this huge hit to cash early, right? That's how that works. And then after the data centers get up and running, after the chips, the AI sort of really starts to pay off, this rebounds, I would think. But if you notice, I think the expectation is that the cash is going to sort of flatten off and sort of like recover starting next year. And so I'm wondering if that's either because there's going to be less investing into this space, or because they're seeing more return finally on some of these investments they've been making. We'll see.
Yeah, I mean, I think it's a little bit early to tell on some of this stuff. If they're spending, I guess the trick would be, and I'll do this another time. I always say I'll do it and I'll come back next week and talk about it. Unless you guys remind me, I won't remember to do this. But I'd love to look at the amount of buybacks all these companies are doing too. And because that definitely juices EPS. We know that you reduce the share count. These companies also use stock-based compensation. So on the net basis, you'd ideally like to see those come down. So
with that being said, do you think that, so let's say they've been doing buybacks.
Oh, they've been doing a lot of buybacks, sure.
Absolutely. With cash now being so low for these companies, can they do buybacks at this time the way they could prior?
Well, I don't know. I haven't researched it.
I guess that's something maybe.
Because you can use free cash flow for buybacks.
Right, exactly. And I mean,
if you didn't tell me that they were spending a lot of CapEx, you could have told me that they're spending all their money on buying back their own shares.
Right. That makes sense.
Or they're paying it out in dividends and stuff.
So take the Microsoft, for example, though. I mean, is Microsoft trading where it's at, and you see this huge dip in their cash flows? It's down to, it looks like it's decreased by about 30% from 100 billion down to 70 as of this year.
Well, I think this is a chart crime though, and it only shows you through year to date 26.
You want to see further. I just, you'd mentioned before with the OpenAI stuff, is Microsoft sort of being punished and Apple not?
Well, it's a proxy trade, sure.
Right. And we've said Apple sort of sat back and watching all of these guys do this and not really acting yet. And
it's clear they haven't done anything because Siri is horrible.
I know. And that's the thing though. It makes you wonder, are they waiting for someone to build a better or what happens if OpenAI goes under and someone's going to buy it? I think you've talked about that before last week.
Well, I mean, it's not a prediction. I'm just saying, is OpenAI Netscape, the browser, which nobody remembers, younger than me, or do one of these win? All right, let's move on though. Let's go to, I think I've been critical of prediction markets because it's one of those things that I don't know why there's a need for it. And I think some of this is open to manipulation. And I'm not sure about this, but I believe people can bet on things or put a prediction in, not a bet, wink, wink, that somebody's going to win an Oscar or who's going to win a political race or who's going to win Survivor. I don't know if they put those on there or not. But these are ones, a lot of times, the outcome is known ahead of time. So anyway, Arizona, where I live, announced Arizona AG, and this is from, where am I reading this from? NPR. So Arizona AG files criminal charges against Kalshi over illegal gambling. And I'll read a little bit. Accusing Kalshi of operating an illegal gambling business in the first ever criminal charges filed against the wildly popular prediction market site, where people bet billions of dollars a week wagering on sports, elections, and what politicians will say during public appearances. Yeah, that can't be manipulated. Anyway, state prosecutors allege that Kalshi, which is based in New York City, is running an unlicensed online gambling operation that lets residents bet on sports and elections without ever having received approval from Arizona. Okay, let me translate this a little bit. Arizona's not getting money from this. Arizona does get money, and other states, from those partners that are approved to operate in a state. They get a cut. There's also gaming compacts with different tribes in Arizona for who gets to have what at their casinos, and then the online stuff, and that all had to be worked out. So the cynic in me says that Arizona just wants a piece of this, and if Kalshi gave them a piece, great. But I still go back to, I don't know why some brokerage firms are sort of commingling these prediction markets. So this will be an interesting case to watch because I think it sort of will have to have a ruling of whether or not these are actually betting operations or prediction. Are they like regulated under securities law? Mike, I think, what is it right now? Is it prediction markets? Are they under like the Commodities Futures Trading Association, Commission, CFTC?
I don't know. But I did look, and you can place a prediction on who's going to win Survivor. And if it's right, it may have just ruined the show for me.
Don't say it because I haven't watched it.
I'm not going to say it, but unless this is very wrong, I think I know who's going to win. And so, I mean, that gets to the point, like the only way you can know that is if you have some sort of inside information. That
think about it. Those shows are taped in advance, and Survivor doesn't do the live show anymore. They do the final at the last tribal council. For anybody who's listening to this doesn't know what Survivor is, anyway, Google it. But that's known. So people know that.
Right.
So imagine you worked on the show or you were, imagine you worked on the show or you were on the show. And I think they have contracts where if they say anything, it could invalidate their contract or they could be held liable. But who's to say if you were on that show,
your contract saying anything? I'm with you. They're doing stuff about like what someone will say on live TV, like whoever writes the prompt for whatever, sports announcer's reading at any given time. Can't they dictate that?
Well, the one guy did an analyst call and he said, for the prediction markets, Bitcoin, Ethereum, he named off like 10 different things at the end of it, which made people win their bets. By the way, according to AI, Google's AI search, the CFTC regulates prediction markets by treating event contracts as derivatives, swaps or futures under the Commodities Exchange Act. Like, this is ridiculous to me. How can this be a security?
Just wait. They're going to do 15-minute. They're already doing it on crypto. We're going to have binary options, which are illegal in the United States. You're not allowed to trade binary options on the indexes in the U.S. They will do them via event contracts is the plan, from what I understand. They're talking about. And for those who don't know what binary options are, it's essentially a very short-term period that you place a wager on whether or not the value of an index or a currency or whatever is above or below a certain price. And these usually range from 1 minute to 5 minute to 15-minute windows. It's very odd to me that these are illegal and the form of binary options, and yet it might sneak in via event contracts.
I don't know. I don't think this helps anyone.
No.
I don't understand why is I know why it's needed, because people want to bet on stuff. But from why this is anywhere near the investment world, I have no idea. Mike, can you figure this out?
Yeah, no, I agree. It's gambling. And so the fact that it is being tied in with investments, I think this is gambling.
So
like betting on what something's going to do in the next 5 minutes, whether it's going to be above or below a price, that's gambling.
Well, of course Arizona wants a cut of this because they're like, wait a second. We negotiated with all these companies. We said who was going to be here, who wasn't, how much they're going to pay us, all this stuff. And then you have a company coming over the top and saying, no, we're predictions markets. We're not just gambling markets.
Savvy. Yes, exactly.
Is Kalshi a public company? I don't
No.
think so. Are they?
No, but you can apply to be a market maker. It's fascinating. Like, you can just become a local if you have enough money and you can sort of prove you know what you're doing. You can step up and make markets, and you better believe that market makers on Wall Street are actively involved and or preparing to get involved with these markets if they haven't already. And if you really want to get crazy with it, go and look at some of these. You guys talk about like someone knows something ahead of time. Depending on which one, Polymarket, Kalshi, whether or not the account allows its information to be seen, you can see accounts that will go like 15 for 15 on military conflict bets or predictions, or they'll nail crypto, or they'll nail like broadcasts, and that's the only thing they seem to bet on, and they only do it occasionally, but every single time they win. It's hard to believe that someone can hit prediction markets that consistently about geopolitical or whatever it is.
Nick Majuli, who we had on the program, he talked to us about his book, The Wealth Ladder. Good for him too. I just see, looks like it came out in Japan. Oh, it's a cool color, or a cool cover, because it has the Japanese characters on there. Good for Nick. Happy for him. He had something. He was involved in some tweets with somebody, promoting, I guess it's a prediction market. And the person was like, 90 minutes left to attempt generational wealth. The odds are not zero and it's free. You owe it to your grandchildren. And he had a longer reply. But he said, I know prediction markets, I'm quoting Nick, I know prediction markets can seem like funny games, but you can lose a lot more money. Your grandchildren won't forget it either. Like I just don't think it helps anybody. It's really hard because as you go older and you have people trying to do YOLO trades and things like that, and you're just like, man, you just invest over time. Like, it's so freaking boring, but you invest over time. You throw money in the markets. You actually want the markets to go down as you're in the accumulation phase. At the end of, 20, 30 years, it normally works for people. It does. So I don't know. We'll see what happens with this. Like, I don't know what the heck the CFTC is doing involved in this. Like, why don't they regulate, like, I don't know, March Madness betting? Like, that doesn't make sense either, does this to me. And by the way, how thick of a market, like, is the winner of Survivor? Like, talk about an illiquid market. I wonder how much trading goes on there. Don't tell me anything, Mike, but like, that could be one person.
Let's see, what is this?
You can see the market. You can see open interest depending on which
10 million in volume since January.
Are you on Kalshi?
Yeah.
Don't tell me anything. Don't ruin it for me. Well, somebody made the point too. I think it was Aswath Damodaran. It might have been him on Meb Faber's podcast. All right, I might be misquoting him, but it was somebody who made the point, like, if you're a politician and you're in a local race and there's not that much volume on some of these prediction markets, you go in, you have like your backers buy a bunch of your contracts. So then they look and they're like, oh yeah, look at me, I'm winning. Prediction markets have me. Give me more money so I can continue fighting this race.
Yeah, they spoof it.
Yeah. Who said that? I don't know. Maybe it was passed to me. It was another podcast altogether. I thought it was on Meb Faber, but
the power of spoofing.
All right. I don't know if there's anything else to add on this. I mean, just for anyone who's interested in this, you can follow it. But my guess is either Arizona gets money from them and then it's all good, or this actually causes a ruling that it is gambling. Mike, I think you agree with that. So we'll see.
Yeah, just call it what it is.
Just call it what it is. All right. Let's go to recommendations this week. Shane, anything from you?
Nothing from me. I've been pretty busy. I mean, I'll give the obvious March Madness basketball. So sorry if I just took your guys' recommendations, but I didn't watch much college basketball in the regular season this year, and yet
nobody does anymore.
Right. It's just March is the time to watch college basketball. So
Okay. For me, I think I gave a pre-recommendation on Rooster on HBO Max. I'm 2 episodes in. I think it's pretty good so far. So I'll put a buy recommendation on that. I'll reserve the right to put a strong buy, but so far so good. So that's on HBO Max. How about you, Mike?
I got nothing. I was going to say March Madness as well. I haven't watched anything in the last week or so.
All right. Well, we're no help to the audience then.
Nope.
They're on their own. Everyone. You're on your own, audience, this week.
Watch whatever you want this weekend.
Good luck. All right. By the way, just as an aside, I was reading something, I think it was yesterday, about, hey, we need 24/7 trading. Like, this is a good example of, like, we don't need 24/7 trading. Like, people need to watch this over the weekend.
No.
They need almost a cooling off period, right?
No, it's actually, it's bad. I think you need to be able to step away from markets and do something other than that. And if you need to trade on Saturdays and Sundays around the clock, it's not trading anymore. That's gambling.
So Shane, are you going to take the weekends and overnight shift for trading if it goes 24/7?
If it goes 24/7 and I've got to watch, our holdings and make sure everything stays okay, I'll.
Nobody needs this either.
I'll make more coffee.
No one needs 24/7 trading.
No. Because we're ahead of it. The last race happened recently. It was in China. Japanese Grand Prix, Sunday, March 29th. I can't recommend it next week because it'll have happened by then. So Formula One's back on. It's been good so far. This will be the third race of the season.
Yeah, but unfortunately, there's going to be no races in April. So Bahrain and Saudi Arabia are likely to get canceled. Yeah, unfortunately.
And then Miami in May.
Miami in May, but I was kind of thinking, well, maybe they can change one of the later races in Europe to now. There's always the risk of weather. I mean, depending upon where in Europe, or they would switch it to Imola, which had a race last year in Italy, or the Nuremberg Ring, which doesn't have an F1 race, but I think used to at some point, which is an interesting track. But so far, I think they're just going to cancel them, unfortunately.
Yeah.
So, or maybe they'll fit them in later.
I think they're supposed to be in the Middle East again at the end of the season. So that's maybe they'll.
Well, they are, but
at the end, but
you can't run these in the summer. It's too hot.
No,
it'd be like doing a race in Arizona in July, even at night.
Yeah.
Well, the tires and the drivers actually. It's too hot. They had races in Singapore, and I remember them pouring ice buckets during the pit stop on the drivers, and it did nothing really. So, all right, that's it. We're done. Have a good weekend, everyone. We'll find out next week what we got right and what we got wrong. See you, everyone.